So I'm going to tell you quickly about myself, how I got involved with emerging markets, how I think about investing. And then I will tell you what I think are the most important things to know about emerging markets when it comes to investing. Now, you all live in an emerging market, so in many ways you will know parts of the story better than I do. But then I'll hope to convince you that the best way to invest in the growth in emerging and frontier markets is through the same place where it's been good to invest in other places, which is the internet company. So in terms of my background and myself, I'm located in San Francisco. I'm actually 15 miles east of San Francisco. I'll be going to San Francisco as soon as this talk ends to see the Golden State Warriors play. If you're a basketball fan, it happens to be Latin American Heritage Night as well. So, that's where I live, and I've worked here in the investment business for 30 years. I started off at an investment firm in San Francisco that was known for technology investment banking. They gave me a short interview and told me I could start work on Monday. I said, I can't start work on Monday. I don't know anything about investing. And they said, well, go buy this book and read it. And I went and bought this book and read it over that weekend. You may know the book. It's one of the main books in the world of indexing. It was written first in 50 years ago in 1972. And in the first edition, the author, Bert Malkiel, suggested that somebody should make an index fund. And not too long later, his friend John Bogle did that. And the author, Burton, also was pretty instrumental in the ETF development. He was the chairman of the committee that created the first ETF, the Spider. So that's how I started, was reading all about indexing and efficient markets. But when it comes to investing and business, I'm an Omaha person first and foremost, and I try to think about everything in the investment world through an Omaha lens. But for the last 20 years, I've ended up working with this guy as my business partner. So I've had one foot in the indexing world, one foot in the active world. Without going into the details, but we ended up, I ended up becoming an advisor to a bunch of the Google people right after they went public, largely because Burton had given a talk to the Google employees about investing. And so all of a sudden I was going back and forth to Mountain View in 2005 to meet with these Google people and help them invest their portfolios. And my partner Burton had gotten interested in China. A couple of his Princeton colleagues were Chinese and had returned to teach economics in Beijing. And he started going back and forth to China while I was going back and forth to Mountain View. And all of these, he ended up writing a white paper about investing in China. And the Google people called me and said, hey, can Burton come talk about China? I said, sure, next time he's in town, we'll come down. And I drove down to Mountain View 16 years ago from San Francisco, and Burton gave his talk about China. And all these people looked at me and said, we want to invest in China. And that was 16 years ago, and I'm still working on it. I think I have it figured out. So now let me tell you how I got involved with China, or what I've learned about China and emerging markets over the last 16 years. So first of all, in terms of the sizing of this, in terms of population, GDP, market capitalization, this is approximately 60% an Asia story. Call it 20% Latin America, and then 10% Africa and the Middle East and Eastern Europe. The Eastern Europe part of the story's gone basically to zero, but that's a different topic. So that's what it looks like on the map. Fundamentally, this is where all the people are. You've got 85% of the world's people in the developing world. Even more of the future, there's about 90% of the people under the age of 30 are in emerging and frontier markets. And the thing that's happening, if you look on the right side of this slide, you'll see the emerging market share of a number of categories. The top red arrow is showing you again that this is where most of the world's people are. The two lower red arrows, however, are showing you that in the consumption categories, retail sales, consumer spending, emerging markets are way behind. And it's the closing of that gap, the narrowing of that delta. That's the story. The thing that's emerging are the people, billions of people, and they're making more money and they want stuff. They want more and better food. They want more and better clothing. They want appliances. They want to go to movies and take vacations, and they want their kids to go to college, and they might even want a car. So now I didn't have to figure this out. It was pretty well documented when I got pulled in 16 years ago, and you can see McKinsey calls it the biggest growth opportunity in the history of capitalism. So that's the most important lesson I learned in those 16 years, which I learned on the first day. The second most important thing to know is that the traditional approach to investing in emerging markets is totally broken. And there are multiple problems, shocking problems. And the first one I learned about in my first 5 minutes after we got back from Mountain View 16 years ago. So after the Google people looked at me and said, all right, we want to invest in China, we drove back to San Francisco, and I walked over to our portfolio managers and I said, the Google guys want to invest in China. Give me a list of all the companies in the China ETF, which is an iShares fund with the ticker symbol FXI. It was the only China ETF in the world, I think, at that point, and it was still less than a year old, but it did exist. And I wanted to see what the companies were, because with my Omaha hat, I don't care what the title of the ETF is. I want to see the actual companies that I'm going to own. And so I asked for the list, and before the PMs gave me the list, Burton pulled me aside and he said, look, when you look at the list of all the companies in the China index, you're going to see that almost all of them are government-owned banks and oil companies. And I said, yeah, I've heard about this. And I knew that wasn't a good idea for multiple reasons, and it wasn't. These are a horrible way to invest if you're trying to make money. These are legacy economy companies. They have conflicts of interest. They have poor corporate governance, is putting it mildly. There's corruption rampant, and you don't have to look very far. And it's still about a third of the index. Now, I'll have to update my slides because I flew to Mexico City on February 27th, just as Russia was rolling into Ukraine, and I didn't get back till a few weeks later. But this next slide, it used to be the oligarchs and the chaebol. If you counted those, it would be 50% of the index. But now the oligarchs aren't in the index anymore. So either way, this is why you don't want to invest in these state-owned enterprises. And that's the big problem. Now, let me tell you what's good that's going on in emerging markets. And I'll also make sure I tell you why this good part of the story is getting missed from the index. The MSCI, the FTSE, the broad emerging market indexes have, again, as I mentioned, lots of problems. So let's go back to the first thing. It's all about the consumption. Now, the reality is there's 3 different mega trends that are happening in emerging and frontier markets. And here in the United States, we kind of forget that these are big mega trends because we've had them for longer than anybody. And what we don't appreciate is that all over the world, everybody else is joining these mega trends. What's the first one? We already talked about it. We've had consumption in my family for multiple generations. Other places are just now starting to have a little extra money to buy whatever it is that they'd like that they don't currently have. And that is a big deal. And again, McKinsey calls it the biggest growth opportunity in the history of capitalism. So that's the first megatrend. The second megatrend is called the computer. Now, when I decided to make EMQQ, it was because one of my friends called me 8 years ago and said, what's the best emerging markets ETF for my 3-year-old daughter's college fund? And everybody else that had called me and asked me that before, I said, that's easy. Buy the emerging market consumer ETF, the food and clothing companies. But someone called me 8 years ago and asked me what was the best emerging markets ETF, and I answered that call on my iPhone. And as I started to answer the question, I had a light bulb moment, because what I realized was consumption was changing. And it was changing in my life, but it was changing gradually. I had a computer for 30 years now. Well, the reality is all of these people, many of them already, but many more every minute, are getting their first ever computer. And it's not on their desktop in a normal sense. And in most cases, it doesn't have an Apple logo. So the world is getting their first computer today. It's in their pocket and it's running on Android, and it costs $50 or $60 brand new. And it's bringing with it the third thing, which is something I got first in 1995 on a telephone line in San Francisco called the internet. It then went on to cable, and then they gave us Wi-Fi. And now we get the same speed in our pocket wherever we might be, including perhaps even an airplane. So the rest of the world has never been wired. So all of these billions of people are getting their first computer, their first access to the internet, and very importantly, because the consumption infrastructure in emerging markets is by definition underdeveloped, meaning that nobody has a bank account, there's no cable televisions on everyone's wall, and there may not be a Target store nearby. And so all of these people are leapfrogging traditional consumption, and in many ways are more digitized than we are. And either way, this is the money slide, as we say, literally and figuratively. This is showing you the revenue of the 131 publicly traded emerging markets internet companies that are in the EMQQ index. And you can see that's a 12-year growth rate of almost 38% a year on average, including a 38 last year, which it'd be hard to match that up against this chart of our performance. But this is a fantastic story of growth. And I'm not positive, but I'm 99% sure it's the fastest growing sector in the world. And I offer a $100,000 reward to anybody who can show me a sector that ever grew at 38% a year for a decade. And I've offered that reward to about 60 other CFA societies around the world so far. So I could be wrong, but nobody I know has been able to show me a sector that ever did this before. Now, again, this last year was 38%, but that's going to come down this year and going forward for the broad index. And now our recent performance isn't particularly good, as you can see in gold. Our long-term performance certainly quite a bit better than the index, the broad index in blue. So the gold is the emerging markets internet index. The blue is the traditional MSCI index. And if we made this chart 2 years longer, the MSCI emerging market index has a return of 0 in 15 years. So, and why is that? Well, in Omaha, investing is really simple. Earnings equals value, and growth of earnings equals the growth of your value. And if you look at the lower right, you'll see a circle or an ellipse or whatever you call it. And you can see at the very bottom, the emerging markets index hasn't grown earnings in 10 years. Meanwhile, the internet companies have done even better than the FANGs. Now, this is a story that's been kind of in our face in the United States. biggest IPO in US history, Alibaba. And now that was another problem that shockingly still exists. When the first day I got involved and I asked for the list of the companies in the China ETF, they gave me the warning about state-owned enterprises, and I went down the list and I got to the bottom, and Baidu wasn't in the China ETF. China, the Google of China, Baidu, which actually went public before Google. And we called the iShares people and said, "Where's Baidu?" And they said, "Well, we don't own it." I said, "I can see that. How come?" I asked. They said, "We don't consider it a Chinese company." And I said, "What do you mean? It's the Google of China." And they said, "Well, but it trades on a US exchange." And I thought that was the stupidest thing I'd ever heard. I complained about it for a decade. And finally, Alibaba's IPO shined a light on this, and even the mainstream press covered this. And they did add Alibaba 3 years later to the broad indexes, but the vast majority of these emerging market internet companies are not even in the index. And it's not my job to help FTSE and MSCI and those types of people figure it out. But one thing I've been shocked about after getting pulled into the indexing world is there's not a lot of original thought or even thinking about things beyond just this is what the list is. So now China has a lot, is the biggest part of the story. Tencent, the other super app. These companies have digitized, Alibaba and Tencent have digitized every vertical. They have become little monopoly-like conglomerates: healthcare, entertainment, food and groceries, and most importantly, banking and fintech. And this is one thing people in emerging markets definitely know, is that fintech is the story. It all starts with getting money on the phone. And once you get the money on the phone for payments, then you're in business, and you can sell investment products, insurance products, and you could do banking and lending, which is what got Alibaba in trouble. So now the China story, again, isn't just Alibaba and Tencent. There's a lot of other very large and profitable Chinese companies. In fact, China's e-commerce market, if we're going to reclassify every country in the world by internet, China is not an emerging market. It's the most developed market in the world by far. And its e-commerce market is 4 times as big as the other 45 emerging markets combined. 45 other emerging markets, China's 4 times as big as all of them combined for e-commerce. But now we're entering into the next frontier of the story, which is, you can call it XChina, but FMQQ is our emerging markets internet product that doesn't include China. And there's, I think, reason to be bullish on both versions of it. But if you look here, as I mentioned earlier, China's e-commerce market dominates. It's dominated our portfolio. This is actually the lowest it's been. Historically, it's been about 65%. So this has been a China story. But what's happening beyond China in Brazil and Mexico and Colombia and Turkey and everywhere is getting very exciting from a smaller base. So you're looking at the revenue again here. You can see this shows you the same revenue bar, but this time the China revenues in gold and the non-China, the FMQQ countries in purple. And you can see that the China passed 100 billion in revenue about the time I launched EMQQ 8 years ago. The FMQQ countries are just now reaching 100 billion. So now, why you should be excited about that, or the math might seem interesting in terms of people looking for growth, there's 4 times as many people in that purple. 4 times as many people in that purple as in China. And in terms of e-commerce penetration, well, China's the most advanced e-commerce market in the world, and its e-commerce penetration is getting close to 30%. Meanwhile, on a population-weighted basis, it's about 4% in the rest of the world. So all of those other people are way behind in the story, but that's changing at an incredible rate. And now, let me tell you about some of these companies and the geography. So MercadoLibre was one of the companies. In fact, I was pretty deep in the China internet companies. Going back to when they first had them, Baidu. And I knew all about them. And I launched a fund that trades with the ticker CQQQ with the Guggenheim people to track that group. But MercadoLibre came onto my radar about 13 or 14 years ago, and I was an investor in it. And it looked like a Chinese internet company in terms of its income statement. And then I realized it was not in the index either. And so this company, you know, well, likely. This company inspired EMQQ. This was part of my trip, was to go visit MercadoLibre. I gave a CFA Argentina talk as well that morning, but this company embodies so many parts of the story. First of all, it's not in the index. It's never been in the index. The fact sheet says it's Argentina, but that's true. They're headquartered there, but the biggest part of the revenue is Brazil. So there's this continuing database problem. And it's also the company that showed us in our face how big fintech was. The company kept crushing their numbers a few years ago, and it doubled twice in a 2-year period. And now the fintech's bigger than I think more profitable, the other part of the business as of the fourth quarter. And it's also an example of this ecosystem that's developing that I believe, based on my 2.5-week trip, I think I'm more confident in this long-term story based on what I just saw on the ground in South America. And it's this ecosystem and this I'm still trying to find the way to describe it, but this virtuous cycle where you've got the successful companies like MercadoLibre, and you have founders that get rich and employees that get rich and investors that get rich. They go off and form formal venture funds like COSEC or do angel investing. And these founders, they're all local, for the most part, local to whatever country they're operating in, but they're going to Harvard and Stanford and MIT and Oxford, and then they're going to work for Amazon or Google or Morgan Stanley or whoever, and then they decide to start their own company. And it happened with MercadoLibre, and now it's spreading. And let me point out, only 2 of the Latin companies that we own are in the index. So if you own the MSCI index, the only two companies you're getting are the ones in blue here. So I don't know why, it's not my job, but MSCI doesn't seem to know what's going on in the world. Now we've lost our Russian exposure. I'm showing you the talk that I gave for South America, which I did in Argentina, but this was before Yandex was delisted, essentially. Southeast Asia's C Limited, another great example, smart kids from Southeast Asia. They've started this incredible company, C, which trades on the New York Stock Exchange, headquartered in Singapore, but they're operating all over Southeast Asia. And even in Brazil now, their Shopee app has made good headway there. Africa's got Jumia from Nigeria on the New York Stock Exchange. Egyptian's fintech leader, Fawry, trading in Egypt. And last summer, the geographical diversity of the story just exploded. We had Poland's e-commerce leader, Allegro, come public, Turkey's e-commerce leader, Indonesia's e-commerce leader. Kazakhstan has a publicly traded super app that's done great since it went public. It's not in a great geography right now for people that are fearful, and they also had their own little problems, but it's still been a big stock and it's a very profitable company. And one of my favorites in Uruguay, dLocal. I don't know if any of you all know this company, but this is one of my personal favorites, and then stock I own individually. A fintech company that the database will say Uruguay because that's where they're headquartered, but the map on the left shows you where their revenue is coming from. They've got a B2C back-end fintech payment solution that is quite profitable and growing very fast. And finally, India is about to explode. We have the food DoorDash, if you will, the Uber Eats of India's Zomato. And when this company came public, it marked an important point. This was last summer. There's now more non-China companies than China companies. So you can see the emerging market ex-China internet IPOs has basically gone up 500-fold in the last 5 years. And the pipeline is full. The market conditions have gotten soft. GoTo, actually listed at the top here, is trying to pull off an IPO. The valuations, I think, going to be down from this 40 billion. But the Indian IPOs, there's dozens and dozens. And we've created a new India Internet Index, which we call INQQ, which should be available for investment sometime in the next couple of weeks. And India really is its own unique opportunity. A few IPOs came out last year, but there's a ton coming. This is one second self-made woman billionaire in India, the founder of Nykaa beauty app. Paytm was the big fintech IPO. These guys top ticked the market, and they're down about 75% since they went public 6 or 7 months ago. But this is the best positioned fintech company by many accounts in India. It's got Warren Buffett's money, and it's also got Ant Group as an investor, and a lot of positive things going on from a macro level for this payments and fintech story in India. And Nubank also came public. This is a stock that the valuation got talked down before the IPO. The stock got beaten down pretty good. But again, it's this virtuous cycle. You've got smart kids, in this case, David from Columbia, who goes to school at Stanford, and then he works at Morgan Stanley, then he gets his MBA at Stanford, and then he works for Sequoia, and he gets funded by the guys that try to MercadoLibre, and then he gets money from Berkshire Hathaway. And so this ecosystem thing is, I'm seeing it everywhere. Pakistan has its own version of this. Colombia, you probably know, has now the Rappi Mafia. So this story, I think, is very, very strong. Of all the places I've seen e-commerce, it's hard to imagine anything being more intense than the streets of Bogota and the Rappi drivers. I've never seen so much e-commerce in my face on a city street as I did in Bogota. You've got Kavak coming soon, hopefully. And even Pakistan and Bangladesh on the left and right of India, they've got their own ecosystems. And again, it's the smartest kids from their countries. They're going to our best colleges or Europe's best colleges. They go to work for McKinsey. They go to work for Snap. They get funded by LinkedIn or whomever and go back, and they're doing amazing things and digitizing everything. So this is the story, and it's changing people's lives. I mean, we and other parts of the world have come into technology in somewhat of a gradual level or an evolutionary level. These people are going from 0 to 100 like in a snap, and their lives are changing in so many ways overnight. Mostly good, but not all. So nonetheless, this is a growth story. I think it's an unprecedented growth story. I could be wrong. If you know of a sector that's grown at 38% for a decade, let me know. A side benefit in a part of the world where corporate governance is your biggest enemy, including these state-owned enterprises, you actually get companies with very good corporate governance because they've been funded by Harvard and Stanford's endowment and people like Berkshire Hathaway. So, versus a state-owned oil company, you probably are in better hands. And you get a lot of exposure to the frontier markets and a lot of the private companies that other public companies have invested in. Now, China, here's our chart, and it's a spectacular crash, to say the least. So I left, we were already down pretty good, and then I left to go to South America. I think we were about this 40 mark. And that was when the Russians were just going in. And we were down 30% from the day I landed in Mexico City to the day I took off. We were down 30% on top of what was already a pretty big wipeout. And literally an hour after my plane took off from Rio, we were back up 25%. So we're up from here, but we had an incredible just crush. And the thing that's hardest about it is that there's not really a fundamental reason to point to. You would think that something significant would have happened to the story to cause this incredible correction. And there's been a lot of fear, and that's for sure. And it's been all about the Chinese government. They're going to steal my money. They don't believe in capitalism. They're going to make, they're going to take over Alibaba, just all sorts of fear. And the irony is, you got two things going on. First of all, you've got the China regulatory fear. Everybody in the world's trying to figure out how to regulate their tech giants, right? These companies have grown at 30, 40, 50% for a decade. And when you grow at that rate for a decade, you become very, very big. No regulators have been able to keep up, and it's in the paper every day. And including today, and on the day that we had one of our biggest fear attacks, that the FANG stocks are getting attacked. And the only difference is China doesn't have all the lobbyists, and people are afraid of China. And so as they try to regulate their internet companies, people freak out and run for the hills. You also have this boogeyman, this delisting thing where the Chinese listed companies are going to get kicked off the US exchanges. This is the dumbest, biggest waste of time and the most intellectually dishonest dramas that has played out for 2 years. I'm shocked how little people understand what the delisting means and how little risk there is in a delisting. Even a lot of professional investors seem to think that that means I'm going to wake up one day and my Alibaba shares are going to be worthless and I'm going to lose all of my money. And that is not going to happen. And but I am bothered by the issue because it's completely intellectually dishonest to think that this is going to happen, and B, that owning a Hong Kong listing is safer than owning an ADR. We've gotten pressure, like, are you going to convert your ADRs to Hong Kong shares? And I don't want to, because it doesn't make any sense. It doesn't actually change any of the risk profile, which is already not an issue. But I may give in and just say, okay, fine, we switch them to Hong Kong, just so that people won't be worried about it. But it won't matter, because other people will be worried about it. And the Hong Kong stocks will go down too, if the New York ones do as well. So either way, I think this thing's totally overblown. People keep reacting to it negatively. If you really dig into it, there's way more questions about our government. The PCAOB, the actual entity that's supposed to be doing these audit reviews, is a complete disaster. And part of the reason that these negotiations haven't gone anywhere is because the entire executive team of the PCAOB and all of the board members were fired last year in July. So the Chinese regulators don't have anybody to talk to, because they fired everybody for a number of scandals, which you can read about if you Google it. Big problems in that accounting watchdog. So there's real things to worry about in China. The real estate bubble, the COVID's just showing up there. They kept the first version out, but the new one's there, and they're not going to stop it. They're trying to, I think, at least slow down the way it rolls through. But there's real things to worry about. But don't worry about the Chinese government, and don't worry about the delisting threat. But it may affect things in the short term, as it has recently. Also, the Russian stocks halted these. We didn't remove these from our index, but we can't trade them, and we marked all of them to zero, which obviously there's a lot of worse things going on in this Russia situation, but here's a bunch of companies that people rolled up their sleeves and built that are now, at least on paper, worthless and unfortunate. Hopefully they can figure out their problems and rebuild their digital economy. And it would be hard to understand, how the decline in our stock chart. When I sat there in Rio on the 15th and we were down below our initial public offering price, it was a strange day because nothing had happened in the last 13 months. I mean, there was a little bit of headwinds from the fintech regulations. I mean, talking about fundamentally, a little bit of headwinds, but the fundamental story is intact, and we had 37% revenue growth. So Mr. Market obviously doesn't care right now. In terms of valuations, you can see here, on a PEG ratio basis, this is revenue growth. I've got another one on earnings growth. I like to use the PE over revenue growth because that's, to me, the most organic measure of your true growth. The earnings growth is actually faster now than the revenue growth. So the actual PEG ratio is even lower. But on a PE to revenue growth basis, these are selling at a fraction of the US S&P 500 and our other tech benchmarks. So this is it. This is where the growth is. And for investors that have 5 or 10 years or longer, I think this is the place to be. And I certainly think it's made me rethink this emerging markets investing in so many ways, because what's troubling to me is that the US institutions and advisors have basically given up on emerging markets because, what I'll hear frequently as well, I believed in emerging markets the first time, didn't make any money. Then I believed in them again and I didn't make any money. And with a 15-year return of zero and 10 years of no earnings growth for the MSCI, it's unfortunate because the thing that is being used by the institutional investment world to define this opportunity, this huge part of the world, it's totally broken. And so people are giving up on this geography and this opportunity in emerging markets, but there's so much happening and you just can't get it if you're using the traditional approach. So that's the end of my presentation. I would thank you very much. I'm happy to answer a few questions, but as I mentioned, I'm looking forward to going to see the Warriors play at Latin American Heritage Night in San Francisco. So if there's any questions, you can pop on and ask them or just put them in the chat and I'll be happy to answer any of them that come in over the next couple minutes. And thank you very much to the host again for organizing and setting this up.
Thank you, Kevin. It was very interesting. So I have Sergio Alvarez who wants to make a question, please. Sergio?
Yeah, I have a question. In the sense, what is the stance in this fintech development for the emerging markets and the next frontier for these indexes, the implementation of crypto or crypto payments around these economies? As we saw in Russia, most of the development in buying cryptocurrencies was crucial for many people to move their money in a catastrophic situation. How does this fund, what is the stance of these two indexes or these two funds? I would like to hear your opinion, Kevin. Well, thank you very much.
Sure. I don't have much to offer in the crypto world or the currency world. We don't hedge for currency risk. In terms of the crypto as an asset class or an investment thing, one of the things that troubles me the most is people that say they trade crypto. Because to me, that does not mean investing. Trading anything, I don't think is a good idea, but trading crypto, I don't think makes a lot of sense either. I think maybe buying and holding it does. So that's where I normally see investing again, is seeing young people in the United States talking about trading crypto. Now, as was pointed out, crypto has a whole nother value proposition to people in places like Argentina or Russia. And there's a real utility to it. There's a utility to it for sure in a lot of ways, but unfortunately, the vast majority of the activity that I see happening in the U.S. investment world is speculation. And there's definitely an institutional element coming into cryptocurrencies. And I know that certainly there's going to be more crypto opportunities in the emerging market fintech companies than there's going to be, I think, in the emerging market investment platforms, traditional investment platforms that I think we'll have in the US. I just think there's just much more, as was said earlier, utility in it. If you have a currency, your base currency is at risk of collapsing or otherwise giving you the challenges that arise frequently in emerging markets.
Thank you, Kevin. Is there anyone who wants to make a question?
Sergio has his hand up.
He has already make a question.
Oh,
so,
is that it? Okay.
Yes. So I don't have any questions for now. So.
Okay. Well, thank you very much, and thank you for having me. And by all means, we'll make sure to send you these slides if anybody wants them. And if you want to reach out to us, certainly you can see my email address here, and be happy to get in touch. Oh, I see one other question that just popped in here.
Okay.
Do we? Let's answer this last question. Do I expect the trends of EMQQ and FMQ to slow down due to the current macroeconomic situation? I think yes. And also no. I mean, I don't think it's going to go into decline. I mean, the growth rates are going to be affected, and that's happening always in different markets. They're getting faster or slower. Interest rates are affecting, I know, a lot of the fintech companies in South America. And I just think in general, we have this incredibly unprecedented situation where we had this incredible disruption in the form of the plague that dislocated the supply and demand of everything: housing, people, materials. And that was already showing up in a lot of inflationary numbers. And I don't think the inflation numbers that we use in the US are close to portraying what's been happening. Our housing, basically every house in the United States went up in price by 50%. And they said that the annual inflation rate was 4%. So there's a lot of things going on that are going to be macroeconomic headwinds, but they may slow the EMQQ and FMQQ stories, but they won't stop it. So that's the last question from the box. Okay, thanks again. I'll send the presentation.
I have one hand. I think that Francisco, I don't know if it's okay if we can have two questions more or not.
Okay, no, let's do two more, sure.
I have the hand raised from Francisco.
Yeah, that's me. Thank you. Thank you for your time, Kevin.
Sure.
I have a quick question for you, and I know you're probably in a rush, but like, what do you make about the investment thesis that, given the variety of accounting standards across developing markets, the best power play is to invest in dividend-paying companies like DWM and companies that you at least have the cash and you know what you are getting?
Well, there is something great about cash flow. I think historically, yes. I mean, and that doesn't just apply to emerging markets, but I think implied in the way you asked the question is that corporate governance is sometimes, less reliable in emerging markets. And so that, again, you got to have cash to pay the dividends. So that's certainly a good way to find some safety in things. But I think just as good a way is to have your CEO and founder of the company go to Harvard and get funded by, the Princeton endowment and the best investors in the world and the best venture investors and go public, on a US exchange. I don't think you can get better corporate governance than that. And that's part of the beauty of this EMQQ story is, there's so many more coming. There's 30 South American unicorns. 75% of the founders went to Stanford. And so you have all sorts of the legacy economy beyond just the state-owned enterprises. The publicly traded companies have questionable sort of corporate governance. So I think that this pot of emerging market entrepreneurs and this virtuous cycle of funding and venture investors, I think that's the best way to get safety in your corporate governance. Obviously, dividends have another important value, and these companies don't pay much of anything in dividends now, but 75% of them are profitable. So these aren't, a bunch of companies with huge burn rates. Some certainly, but the majority are profitable.
Okay. Well, I have a question, but if not, I can send you an email for them later.
Okay.
So will we finish now? Okay.
Yes. Thank you very much, everybody. And by all means, you have my email right here, my phone number. If you have any follow-up questions, definitely give me a reach out. And thank you all for your time and have a great evening.
Thank you. Thank you
Okay.
all. Thank you, Kevin. Good night.
Okay. Ciao, ciao.
Bye.